Good to have you with us this morning. Thanks for joining us. Let's check those U.S. futures again. We mentioned they are weaker, based in part on some of that data out of China. We're also going to be watching some headlines out of Washington on the debt ceiling drama later today, as we also await the latest read on U.S. inflation this week. Of course, the path ahead for interest rates in Canada and beyond seems to be constantly on the minds of investors. Let's talk to somebody who lives and breathes this stuff, Earl Davis, who's head of fixed income and money markets at BMO Asset Management. Earl, nice to see you, sir.
A pleasure to see you as well.
Okay, so there's this broader theme of where we're going from here and how the markets are supposed to, I guess, position around that. What's been your general view recently?
Yeah, it's been a word we've been using for like past 6 months, resiliency. We're seeing resiliency in the labor markets. Now we're seeing resiliency in the housing markets. And I think this is surprising a lot of economists. It's surprising the central bankers and complicating the next steps for them.
I almost feel like it actually sets us up for a bigger bull versus bear debate, right? People who just don't believe in the data say something's got to give and you got to be cautious, while others saying, well, why? If the data is holding up, why do we have to be so cautious?
Yeah, and you know what's very interesting about the data coming in? The most negative part of the data is surveys. Surveys, people asking individual citizens, and they're reflecting what they're seeing on the news, what they're seeing in public. But the actual data itself is, we're seeing economic surprises to the upside.
What would be the prime examples of that?
Prime examples, you could say, look at the Bank of Canada business survey. How they expect business to come off, but yet they're hiring. So there's kind of a dichotomy there in regards to the expectations versus the reality.
Well, and let's not forget, it had been challenging for a lot of businesses to hire. COVID was very complicating. Canada is bringing in a lot of new Canadians, too. So you've always got to look at demographics along with economics. But I guess for those who are trying to figure out where the economy lands, what happens with interest rates, you've got to make the professional decisions on this stuff. You're not just, the economists saying this or that. How are you positioning?
Well, I'll give you the conclusion, and I'll tell you what we're looking at. Right now, we expect, for the Bank of Canada to be on hold throughout the summer. I think it gets complicated for them starting the fall. And the reason why is the base effects in CPI. It will lower inflation towards 3% by June. But you know what? It goes back up to 6%. Not to say we get there, but it's just saying the big inflation numbers from last year are dropping off. So now you start to see a trough in inflation in June, and it starts to rise based off of base effects.
If it doesn't continue to trend lower, there's just some simple math of comparisons that freaks people out.
And what we're doing, we're assuming the past 3 months of monthly inflation, 0.5% a year, which times by 12 is 6% annualized going forward. But those numbers could be lower. We're just saying base effects are only a tailwind until the summer.
So the inflation story, I mean, am I wrong? Are you in the camp of people who think this issue of getting back to 2% inflation is deeply challenging because of the world we're living in right now?
Yes, and that's what you call a secular change, the deglobalization. Supply chains are easing off, but the deglobalization, the war effect and the like could lead to higher inflation for longer.
So let's talk about what that means, for example, for companies. So like we're getting to the tail end, it feels like, of earnings season, but we get a lot of profit outlooks. When you look at the performance of businesses, would you say they are resilient? And given what you're talking about with the economy, can they stay resilient?
Yes, definitely. It's interesting when you look at the first quarter or the latest releases. In the U.S., 66% of the companies reported 12% gains. That's more than inflation. So what that says is they're able to pass through prices. And that's where that long-term sort of inflation spiral could come from.
I still feel like we have to bring it home on what an investor should do in an environment like this. So take it away, Earl. What would be your advice right now?
So as an investor, we like credit. We like IG credit. So your
investment grade.
Investment grade company.
Exactly.
And the reason why we like it, we think, you know what, if we have a recession, it will be a soft one right now, soft landing. So that says the company should still do well. They're also able to pass through prices. As long as employment stays low, people have money to spend and will pay those prices. So we like investing in being overweight investment grade credit, to tell you the truth.
So that's not a risk on per se, but it's not a risk off, I would say.
Yeah, I would say it's slightly risk on.
Okay.
You're not in government bonds, you're in credit product, but it's very attractive, And we expect the stock markets just to hover around here. We don't expect to see any large gains with stocks, but we don't expect to see a sell-off as well.
Just because of?
Here's an interesting fact.
Okay.
10-year bonds today are around 285, exact same spot they were last year at this time. Overnight rates are 300 basis points higher, but 10-year bonds are. So because of the stability in the longer-dated bond market, that's passing through into stock prices from a valuation perspective and a discounting perspective.